Welcome back to our trading series. If you're new here, we just covered the basics of trading in our first video. Today, we're taking it a step further to explore the two primary types of market analysis every trader needs to know: technical analysis and fundamental analysis. So let's get into it. Let's start with technical analysis. This method focuses on studying past market data, mainly price and volume, to predict future price movements. It's all about finding patterns and trends that can indicate where the market might be heading. You've probably seen charts like this one. This is a candlestick chart, a favorite tool for technical traders. Each candlestick represents the price movement within a specific time frame, showing the opening, closing, high, and low prices. We also look for support and resistance levels. These are points where the price tends to stop in reverse direction. Traders use these levels to plan their entries and exits. For example, if the price hits a support level and bounces back up, it might be a good time to buy. Besides charts, technical analysis uses indicators like moving averages, the RSI, Relative Strength Index, and MACD, which stands for Moving Average Convergence Divergence. These indicators help traders understand momentum and potential trend reversals. For instance, if the RSI goes above 70, it indicates that the asset might be overbought and it's time to sell. If it's below 30, the asset could be oversold, signaling a potential buying opportunity. Now let's switch gears to fundamental analysis. Unlike technical analysis, which focuses on price patterns, fundamental analysis looks at the underlying factors that could affect an asset's value. Think of it as looking under the hood of a car before buying it. For stocks, this means analyzing a company's financial health, its earnings reports, revenue, profit margins, and even management performance. For currencies, you'd look at economic indicators like GDP growth, employment rates, and interest rates. Let's take a quick example. Suppose a company releases a strong earnings report with higher than expected profits. This positive news can drive the stock price up because it indicates the company is performing well. So, which one should you use? Well, it depends on your trading style. If you're a day trader looking for quick opportunities, technical analysis might be your best friend. But if you're in it for the long haul, understanding the fundamentals will help you make better investment decisions. But here's the secret sauce. The best traders use a combination of both. They might use technical analysis to find the right entry point and fundamental analysis to choose what assets to invest in. For example, they'll pick a fundamentally strong stock and wait for the right technical pattern to appear before entering the trade. Simple. In summary, technical analysis helps you understand when to trade, while fundamental analysis helps you understand what to trade. By mastering both, you can make more informed decisions and improve your trading strategy. I hope this video has clarified the differences between technical and fundamental analysis. If you found this helpful, don't forget to like this video, subscribe to the channel, and hit that notification bell so you don't miss the next one.